Today we are going to discuss about portfolio optimization with the real world data. As you can see, I have extracted some monthly price data from Columbus Stock Exchange, and you can see I have selected 10 companies. These are the company IDs and these are the names of the companies. For all these 10 companies, I have extracted price data. These are actually monthly price data from 2010 December to 2013 December. So altogether I have 3-year monthly data for all these 10 companies. These are actually closing prices. So what we are going to do today with this set of data, we are going to use these 10 stocks to calculate some portfolios, and based on the portfolio returns and as well as the variance, we are going to derive efficient frontier for the set of portfolio that we have selected here. And based on the efficient frontier, we are going to derive capital market line as well as the security market line. So that is our purpose today. In order to do that, first what I am going to do is, based on this sample of stocks from the Columbus Stock Exchange. So these are the monthly price data. Based on those data, what I am going to do is calculate the monthly return for these 3 years. So for that, I'm going to use this particular formula. This is actually an Excel function. Normally we use this particular function, this natural logarithm function, in order to calculate the continuous compounded return for this monthly price data. So what I'm going to do is I'm going to select one of the cell here. This is actually corresponding to the company UCAR. So according to the formula, I'm going to type equal natural logarithm ln and current price divided by the previous price. And we have monthly return for UCAR for the month of January 2011. So what I'm going to do is I'm going to copy this formula down, and I'm going to drag this so that you can see Excel will give me the return metrics for all of these 10 stocks for up to 3 years starting from 2011. So you have altogether 36 return observation for a particular company for up to 10 companies. So first what I'm going to do here is I'm going to calculate the mean values for each and every company. For that particular purpose, I am going to use a very simple little function from Excel. It is called average equal average. I'm going to calculate the average of all these 36 observations. Enter. Then I'm going to drag this. Okay. So you get the mean returns. Mean returns of all the 36 observation for this 10 particular companies. So these are actually the mean returns of these 10 companies for up to 3 years. So next thing I'm going to do is calculate the variance. In order to calculate the variance, I am going to use again an Excel function, variance of the population. So again I am going to use this whole set of observation, 36 observations. Enter. Then I am going to copy that formula also. So these are the information that we have here, right? So based on those information, what I'm going to do is I'm going to calculate again standard deviation, because I have the variance value right now. I'm going to calculate the standard deviation. So we all know the standard deviation is equal to square root of the variance. So equal square root, and copy the formula right? So these are the standard deviation values, right? Next step of our process is actually to calculate the variance covariance matrix. Variance covariance matrix, that is actually one of the main, or maybe the central unit of calculation. We need this variance covariance matrix for about each and every calculation we are going to do. So for that, this particular purpose, I am going to use another Excel function which is called covariance. I will show you the path here. So all you have to go to data and select this data analysis package, and from that you have to select the covariance, right? Then what you are going to do is you are going to select your set of data you are going to calculate covariance. So I am going to give all the data set, this 36 observation for about 10 companies, so 36 into 10, right? Then I am going to give the input range here, output range, and I am going to take this particular one, labels in the first row. So Excel will identify these company IDs as the label, and it will give me the covariance variance matrix. So likewise, so this is the variance covariance matrix. So let me do some uh, formatting here so that you can clearly see. So this is the variance covariance matrix, right? But as you can see, Excel only gives us the one part of the matrix. We will have to fill the other one. So I will teach you how you can fill it. So all you have to do is copy whole set of data and paste it, and select paste transpose, right? Again select all the data that you have pasted, copy, and again paste on this particular cell, right click, paste special, select this particular option, skip blanks, and click OK. So it will give you the whole matrix, right? This particular matrix is called variance covariance matrix. So this is how we denominate that, R VAR, R variance. So this variance and covariance matrix is very important when it comes to portfolio optimization. We do a lot of calculations based on this variance covariance matrix. So let me copy this variance information here, then bring it up. So now you can see these diagonal values. These diagonal values are actually representing the variances, right? See, these variance values are equal to each other. Now here the variance between UCAR and UCAR, it is basically the variance of the returns of UCAR of these 3 years is actually 0.04 0.05405. So that is also here in this particular matrix also. So all these values, variance values, are equal. These variance values, we already calculated these variance values here. So we have only copied it down, copied it and paste it here. So you can see these variances. So in this particular matrix, these diagonal values are actually representing the variances and off diagonal values are representing the covariances. Let me give you example here. Now this value 0.00149, that is the covariance between the returns of CTC and LLUB. Or let me take another one. This one here 0.00238, that is the covariance between the returns of Asiri and Lion. So likewise, these diagonal values, those values are representing the variances, and off diagonal values are representing the covariances. So let me copy this whole table. Let me copy this whole table and paste it in the next sheet where we are going to do our calculations, right? And again, let me copy all the standard deviation and return values that we just calculated here. So the return is actually mean value. So I'm going to copy it and paste it here under the return column. Paste special. I need transpose and I only need the values. I don't need the formulas. Right. Again, I'm going to copy these standard deviation values also. Paste special transpose only the values. Okay. So we have this information right here in this particular sheet. Already we calculated these information and I have only copied them from the previous slide, right? So the based on this information, what I am going to do is I am going to create two portfolios. I am going to create two portfolios. I am going to just assume some arbitrary values here for the portfolio weights of this 10 particular stocks. So let me assume some weights. Here I'm going to put 0.1. There's no hard and fast rule. I'm just assuming weights. 0.08, 0.04, 0.08, 0.15, 0.06, 0.09, 0.12, 0.09, and most importantly the summation of all these values should be equal to 1. So I will have to add another 0.19. So the summation is exactly equal to 1. So this I call portfolio 1, or the weights of the portfolio 1, or weights of the portfolio A. Now the denomination here is WPA, that means weight of the portfolio A. This is the portfolio A. And I'm going to assume another portfolio, that is the portfolio B. So arbitrary, again I'm going to put some values here. 0.19, 0.1, 0.08, 0.09, 0.12, 0.09, 0.08, 0.15, 0.04. Again I can enter 0.06 so that it will become again the sum of the whole set of weight should be equal to 1. So that is there. So the next thing what I am going to do is, based on the weights that I have assumed here, I am going to calculate the portfolio characteristics. Characteristics in the sense I am going to calculate the portfolio return and portfolio variance and the portfolio standard deviation, and as well as the covariance and the correlation between these two portfolios. So we have already identified two portfolios here, and portfolio A and portfolio B, and we have already assume these weights for each portfolio, and based on these weights and based on these returns and the standard deviation values that we have already calculated from the stocks, we are going to calculate the portfolio standard deviation and the returns. Here we have individual stocks standard deviation and the returns. Now what we are going to do is actually calculate the portfolio standard deviation and returns, right? So we have two portfolios, portfolio A, portfolio B. For that, in this particular space, we are going to calculate the portfolio return, portfolio variance, and portfolio standard deviation. So first, let me calculate the portfolio return. So in this cell, we are going to calculate the portfolio return of the portfolio A, the return of the portfolio A. For this particular purpose, I am going to use this matrix multiplication. That is actually another function that we can use from Excel. So this is the particular formula that I am going to use. Return of the portfolio is equal to weight transpose multiplied by return matrix. Actually, it is the return vector. Weight transpose multiplied by return vector. These all of these things are actually matrices. So I'm going to add this particular function from Excel which is called mmult, that means matrix multiplication. So equal m mult, and we have this weight transpose, so that means we need a transpose here. So again I am going to add another Excel function transpose, and I am going to select the weight vector of the portfolio A so that I will get the transpose of this particular vector. So I'm going to close the bracket, comma, then I'm going to select the return vector. So this is the return vector, right? Close the bracket, enter. Another thing that I want to share with you, when you have these two type of functions here, you will always have to press enter button holding control shift. So what you have to do is hold control and shift together, then hit on the enter button, so you get the answer. Let me repeat it again with this portfolio B. So what I'm going to do here is actually equal mmult, again transpose weight vector, that is actually weight of the portfolio B, close the bracket, and again select the return vector, close the bracket, and control shift enter. So you get the returns of these two particular portfolio that we have just created. So the return of the portfolio A is 2.18 and return of the portfolio B is 1.97. So the next thing I'm going to do is actually calculate the variance of these two portfolios. For that particular purpose, I am going to use this formula. Here you can see the variance of the portfolio is equal to weight transpose multiplied by this variance covariance matrix multiplied by weight. Weight transpose multiplied by variance covariance matrix multiplied by the weight. Right. So I'm going to use matrix multiplication here also. As you can see, we have three matrices to multiply together. Three matrices to multiply together. So I'm going to use mmult. So I'm going to use mmult and again mmult because I have three things to multiply. So the first matrix is actually weight transpose. So we are going to calculate the variance of the portfolio A. I am going to select. I am going to before selecting. I am going to use the Excel function for transpose. So again transpose. Then I'm going to select the weight vector. So you get the transpose of that vector. Then close the bracket, comma, and then select the variance covariance matrix. Variance covariance matrix and comma. Sorry, close the bracket and then comma, and then again select the weight matrix. So this is how it comes: weight transpose, covariance variance matrix, and weight vector. Right. Control Shift Enter. So you get the variance of the portfolio A. Same way I'm going to calculate the variance of the portfolio B. Equal M mult, again M mult, and then transpose, and then I'm going to select weight vector, close bracket, comma, variance covariance matrix, close bracket, again the weight vector, and close bracket, Control Shift Enter. Right. So you get the variance. And calculating standard deviation is very easy. All you have to do is actually get the square root of variance. Right. So you have these values. So the variance values as well as the standard deviation. So according to this variance, the return of the portfolio A is 2.18% and the standard deviation is 7.63%. And return of the portfolio B is equal to 1.97% and the standard deviation is 6.86%. Right. And the next thing that I am going to do is to calculate the covariance. I'm going to use this particular formula. Covariance AB is equal to weight A transpose multiplied by variance covariance matrix weight B. Weight A transpose multiplied by variance covariance matrix weight B. Right. So again we have three matrices to multiply. So equal M mult, M mult. Since we have a transpose, then I am going to select weight A, weight A, close bracket, comma, variance covariance matrix, close bracket, comma, and weight B. Control Shift Enter, so you get the covariance between the returns of these two portfolios. Then in order to calculate the correlation between these two, I am going to use this particular formula. So all you have to do is divide the covariance between these two portfolios AB, covariance AB, divide by the product of the variances or the product of the standard deviation. Product of the standard deviation. So equal covariance AB divided by standard deviation of the portfolio A multiplied by portfolio B. Right. So enter, then you get the correlation value. You get 0.9. That means it is very close to 1, positive 1. So as we all know, correlation range from -1 to +1. If something is very close to +1 or -1, if it is -1, there is a strong negative relationship. If it is close to the +1, there is a strong relationship, positive relationship. So here we can assume that there is a positive strong relationship between the returns of these two portfolios. Right. Now that we have already created two portfolios using all the 10 stocks, right? Using all the 10 stocks. Then what I'm going to do is I'm going to create another set of portfolios using these two portfolios, right? As the first step, what we did is actually create two portfolios using all the 10 stocks. That means these two portfolio represents all the 10 stocks that we have selected from the Columbus Stock Exchange. Now what we are going to do is actually based on these two portfolios that we have just created, we are going to create another set of portfolios or series of portfolios so that we can plot those risk and return profiles in a graph in order to derive mean variance frontier. So for that purpose, we need risk and return profile of several combination of portfolios. So for that purpose, what I am going to do is I am going to create some imaginary portfolios. So for that particular purpose, I am going to create some weights here. So I am going to start from -2, -2, and I'm going to give a function here so that it will be easier for me. What I'm going to do is equal -2 plus, I would say, 0.25. So you get 1.75. So I'm going to drag this down so that you can at least get some values. This is enough. I'm going to go up to 4.75. So then what I'm going to do is actually calculate the portfolio weight of the other portfolio, the portfolio B. Now here we calculate the weights of the portfolio A. Then I'm going to calculate the weights of the portfolio B. So for that purpose, what I'm going to do is easily I'm going to use a formula. So portfolio weights of the portfolio A should be 1 minus the weight of the portfolio A. Weight of the portfolio B should be 1 minus weight of the portfolio A, because the summation of two weights should be equal to 1. So negative negative 1 negative 2 plus positive 3 is equal to 1. So I'm going to drag this down so you get this value. So you can always verify this. The summation of these two should be always equal to 100%. So you can see it is always 100%. The summation should be equal to 100% or equal to 1. So the next step is to calculate the returns and the standard deviations of the portfolios we have just created. Actually, in order to calculate return, what I'm going to do is I'm going to use this particular uh, formula here. So this is weight multiplied by return. Actually, we are going to calculate the weighted average here. So weights are actually the here it is -2 and positive 3. Right, I'm going to calculate the portfolio return here. So equal weight of the portfolio A multiplied by return of portfolio plus weight of the portfolio B multiplied by return of the portfolio B. So I'm going to fix these two values because I'm going to copy the formula down. So how I'm going to fix this? I'm going to add these dollar marks in between the cell number and the row number and the column number, so that Excel will fix those values. Right, enter and copy it down. right? So you get these answers. Then calculate standard deviations. So I'm going to use this formula in order to calculate the standard deviation. Standard deviation is equal to square root of weight 1 to power 2 variance plus weight 2 to power 2 variance plus 2 into weight 1 weight 2 and the covariance of the two stocks. So equal square root, equal square root. Then we have first part of the equation, weight 1 to power 2, that means we have weight a here to power 2 multiply by the variance of the portfolio A, right? Plus the second part, weight B to power 2 multiply by the variance of the portfolio B. And the third part is actually 2 multiply by weight A multiply by weight B multiply by covariance between these two. So again, since I am going to copy this formula down, I am going to fix these values. I'm going to fix the covariance value and again variance values. Right. Then close the bracket, end. So you get the standard deviation value, then you can copy the formula down. Right, now you get this information. Now we have these return and standard deviation characteristics of these portfolios so that we can plot these values in a graph, for example XY graph. So that's what exactly I'm going to do here. So I'm going to plot these return and standard deviation values, mean values and standard deviation values in this particular graph. So let me do that. So I'm going to go to the design here and select data. I'm going to add a data stream and x-axis should be standard deviations. X-axis should be standard deviations and y-axis is actually the returns of the portfolio. Returns of the Now you can see a type of a curve which actually represent, it is actually a bullet shaped curve. It is actually a bullet shaped curve. This curve is actually known as the mean variance frontier. Mean variance frontier because we have plotted standard deviation against the return of each and every portfolio that we have created, right? Now if you look at this particular curve, you can see actually the tip of the bullet here. This point 6.86% is the standard deviation and the return is 1.97. If you look at the series of standard deviation just we have calculated, let me find out the minimum value here. So I can easily do it using Excel. Equal min and select the range. So Excel will give me the minimum value, enter, and the minimum value is 6.86. Let me locate that value here. Right, if I am going to highlight it, right. Now you can see, out of all the combinations, all the portfolios that we have created a quite a bit number of portfolios here, right? So if you look at the all the portfolios that we have created, all the combination of these portfolio A and portfolio B, this portfolio, this particular portfolio actually gives you the lowest possible standard deviation. That means lowest possible risk. So that is the point here. So that point actually gives you the lowest possible risk. If you want to invest in the lowest possible risk portfolio, you can choose to invest in this particular portfolio. That is actually you will have to invest 100% of your money in portfolio B. You are not going to invest anything on portfolio A. If you are going to invest 100% of your money on portfolio B, you will be getting the minimum risk. But how do we know whether this particular fund trio is efficient or not? Efficient or not? It is very easy actually. All you have to do is plot all the individual standard deviation return profile of the individual stocks in the same graph. So let me do that here also. So again I am going to select the graph and design, again select data. This time I am going to select this individual standard deviation returns of all the 10 securities. So again I am going to add another series of data. So here also the x values represent the standard deviations and y values represents the return. Right. Okay. And okay. Now if you look at the set of data, right? Let me edit this so that you can clearly see this. Right. Now you can see all of these red dots, they are representing the individual assets. This particular bullet shaped curve, that represents the set of portfolios that we have created. We call it mean variance frontier. If this mean variance frontier to be considered as an efficient frontier, all of these individual stocks should be lying within the frontier. Now if you look at this particular frontier, now as we all know, now this particular point gives you the lowest risk, but this particular individual security, if you look at that, it will give you even lower risk, even lower risk, this one. Now it will give you a risk of 6.39, where in this particular point it will give you a 1.97 return and risk is equal to 6.86. Now if you look at this, we can locate the exact this, the lion stock will give you a return of 1.85% and with the risk of 6.39. So it will give you even lower risk than the portfolio you created based on some imaginary weights. That gives you the idea that this particular portfolio is not efficient, right? If it is efficient, these red dots or these individual securities should be plotted well inside of the mean variance frontier. If that is the case, then we can consider this particular frontier as the efficient frontier. But here, this this mean variance frontier is not a efficient frontier. It is not efficient frontier, right? So with that conclusion, what we are going to do next is actually to calculate the efficient quantity, right? For that particular purpose, I am going to go to the next sheet. So we have this information available with us, the same set of information that I have copied and pasted here. So now here our purpose is to calculate the efficient quantity here. In order to calculate the efficient frontier, actually we need to calculate efficient portfolios. At least we need two efficient portfolios. For that purpose, we need to identify weights of two efficient portfolios. Weights of two efficient portfolios. For that purpose, I am going to use these two formulas. The first formula, it will calculate some z values so that we can create some weights of portfolios based on a risk-free rate. Now here the risk-free rate is represented by this C, represented by C. Ri is actually the return, and we have variance covariance matrix to power negative 1. To power negative 1 is actually the inverse matrix. Inverse matrix, that means inverse variance covariance matrix multiplied by Ri minus C vector. And then we have this formula to calculate the weights. That means actually it is very easy. We get the summation of the all the z values, then we get the percentage value for each and every z value. So let us continue with these particular two formulas and calculate the weights of two efficient portfolios, right? In order to do that, I am going to assume two RF values, or here two C values. First one is 1% and the other one is 1.5%. These are just assumed values. You can assume any value you want, but normally in a country we can assume the real risk-free rate here. We can get the uh, uh, 3 months treasury rate if you want, but all you have to do is just assume two values and use these two formula. So let me assume first I am going to calculate the weights assuming the risk-free rate is equal to 1%, right? So here when the RF rate is equal to 1%, that means C is equal to 1%. RF rate is equal to 1%, C is equal to 1%. So all I have to do is calculate the weights here. So first let me take this particular formula here. So first what we have to do is calculate. We already have this variance covariance matrix. We already calculate this. All we have to do is take the inverse of that. And then we need R minus C vector. R minus C vector. So for that, I'm going to calculate R minus C. So R here is actually the return of these particular stocks, 10 stocks. So we have R minus C. C, we assume C to be 1%. So we get this. So here again you will have to uh, fix the value of C, because since we are copying the formula down, so again I'm going to copy that. So you have these values. So the next thing is actually to calculate the Z value here. So you have the formula. Now all you have to do is calculate the Z value. For this particular purpose, actually we need a uh, whole vector of Z values. So we need values for all these 10 securities. So we need 10 values here. For therefore I'm going to use the multiple matrix multiplication function here. So before calculating matrix multiplication, I'm going to select the area that I need answers. Then I'm going to type equal mmult metric multiplication, and I need the inverse of the variance covariance matrix, that is actually, again I need to use another function called minverse. That minverse means matrix inverse. So min minverse, minverse matrix inverse. So I'm going to take the inverse of this particular matrix, right, multiply it by this particular vector r minus c, right, close the bracket and control shift enter. So you get these values, then it is very easy for us to calculate the weights. All you have to do is get the summation of all the z values. So equal sum, select the values and you get the summation. Then you can easily calculate the weights. All you have to do is divide individual z value by the summation of all the values. So I'm going to fix the summation value here, f4. So you get these weights, right? How you verify these weights? Actually, again, you will have to calculate the sum of all the weights. It should be equal to 1, right? Right. That is also okay. Now again, what I'm going to do is assume another value for C. This time I'm going to assume 1.5 as the RF, risk-free rate, and again calculate another set of weights. Now here we calculate weight 1 for weights for portfolio 1. Now here I'm going to calculate again weights for portfolio 2. So again return minus C. I'm going to fix this value, enter, and drag it down, right. Then again Z values, select the whole vector, equal mmult, and minverse to get the inverse of the variance covariance matrix, close brackets, comma, and select the Ri minus C vector, close bracket, control shift enter. Again you get these values. So you get the summation, sum of the all z values, and then you can calculate the percentage values here. Individual z value divided by sum of the all z values, end. So you have these weights and equal sum, just to verify whether these values are really weights, right? Okay, now we have two portfolios, portfolio 1, portfolio 2, and weights of the portfolio 1 and weights of the portfolio 2. So now what I'm going to do here is actually calculate the just like previous calculation, I'm going to calculate the uh, risk and return characteristics of these two portfolios. Now these two portfolios are actually efficient portfolios because we calculated these weights of these efficient portfolios. So this is efficient portfolio 1, this is efficient portfolio 2. So based on these weights, we are going to calculate the uh, portfolio return, variance, standard deviation, and covariance between these two portfolios. Again, I'm going to use the same formula that we used, equal, actually this formula to calculate the return, equal mmult transpose weight 1. This is the weight 1. I'm going to select it and multiply that by the return. Control Shift Enter, so you get this answer. Again, return of the portfolio 2 equal a mult transpose weight 2 multiplied by return. Control Shift Enter, and then to calculate the variances, this is the formula that we are going to use. So we have weight transform, so equal, since we have three matrices to multiply, I'm going to get 2 m mults, m mult, m mult, and again transpose. I'm going to select weight 1 here, so transpose of the weight 1 multiplied by the variance covariance matrix, again multiplied by the weight vector. Control Shift Enter, so you get the variance value. Again, same formula is applied here, m mult transpose weight 2 variance covariance matrix, weight 2 again. Control Shift Enter. Right. Then to calculate standard deviation, I am going to easily apply square root, whole little formula, enter, and drag it here. So you get the standard deviation values. In order to calculate covariances, you can always use the previous formula here, this one. Covariance AB is equal to weight A transpose variance covariance matrix multiplied by weight A vector. So here I'm going to calculate equal m mult m mult. We have transpose weight A here, that means weight of the portfolio 1 multiplied by the variance covariance matrix, and again multiply it with the weight 2. Control Shift Enter, you get it. Even though if you calculate covariance value for the other portfolio, it will be the same, because it is anyway the covariance between these two portfolio. Let me calculate it so you can witness that. M mult m mult m mult transpose weight of the portfolio 2 multiplied by variance covariance matrix, multiplied by weight of the portfolio 1. Control Shift Enter. So you can see here, you can see both the answers, they are the same, 0.0056, 0.0056. Right. Now what I am going to do is, actually I am going to copy all the values that I have created here. All the values I have created here down into the sheet, right? Likewise. Then using these two weights, I have calculated these portfolio characteristics, and based on these characteristics I am going to again calculate the return and standard deviation of this set of portfolios that I have created so that I can plot those values in a chart in order to identify the efficient mean variance frontier. So first I am going to calculate return here equal weight A multiplied by return, sorry, weight 1 multiplied by return 1, and I am going to fix it, plus weight 2, weight of the portfolio 2 multiplied by return of the portfolio 2, fix it, so you get this value. So the return of the portfolio, first portfolio is 6.74%. I'm going to drag it down so you get these values. Then I'm going to calculate the standard deviation the same way. I'm going to use this particular formula. So standard deviation is equal to square root. So weight 1 to power 2 multiply by the variance of the portfolio 1 plus weight 2 to power 2 multiply by the portfolio variance of the portfolio 2 plus 2 multiply by weight 1 multiply by weight 2 multiply by the covariance between two portfolios, this one, right? I'm going to fix these values, f4, 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 enter. So you get the standard deviation value here, and copy it down so you get all these values. So next thing we want to do is actually plot these values. So let me plot these values in this particular diagram. Select data, and I'm going to select standard deviation for the x-axis, and return data for the y-axis. Right, now you get a similar kind of curve. This is also a bullet shaped curve, and you get a minimum variance value here, minimum variance point. It is, again, let me find it out, equal mean, select all the standard deviations so that you can find it out. Yeah, it is 4.18, 4 point, this point here, 4.18. This is the minimum risk point. So in order to achieve this point, you will have to uh, invest in this configuration, positive 2.25, that means 225% on the portfolio 1, negative 125% on the portfolio 2. Negative in the sense you will have to sell 125% of portfolio 2, and using that money you will have to buy 200 225% of the portfolio 1. So if you do it, you get the minimum portfolio risk, minimum portfolio risk. So this point represent the minimum portfolio risk, right? So then what I'm going to do is I'm going to do the little test that we did. Again, what I'm going to do, I'm going to plot all the individual securities here in the same graph. in order to verify whether this one is efficient or not. So x axis could be standard deviation and y axis is returns. Okay, now if you look at the graph, you can see now this is the minimum variance point. You can see all these values are actually well within the efficient fund all these values. There is no any single asset that we can achieve a less risk or less standard deviation than what is available on the efficient fund tree. Now if you look at the previous one, you can see these individual securities are all over the place, right? It is not inside the those individual securities are not plotted inside the efficient fund tree, but those are all over the place. But if you look at the efficient fund tree here, you can see all these individual securities are plotted well within the reach of the efficient fund tree, mean variance fund tree. So if that is the case, we can call this as efficient mean variant fund tree, because there is no single asset that can beat the portfolio that is lying on a efficient mean variance fund tree, right? So any day a portfolio that lies on efficient fund tree is preferable than these single individual assets any day, because if you want to take this particular asset as the example, you get this 1.85% return for about 6.39 risk. But if you just move into this particular portfolio, you get 1.68 return, but your risk is reduced greatly. It is 4.39. If you are here, you get around 6.71. If you are here, you get a risk of 4.79. So there is no any individual asset, individual security that can beat the portfolios that are lying on the efficient mean fund here in terms of risk and return. So with that, we can call this particular fund here as the efficient fund, right? So that is about calculation of efficient fund tree, right? Now the problem is actually how an investor decide on the efficient fund tree. As I explained, each and every combination on the efficient fund tree is a good portfolio. But if you look at here, anything below this point, anything below this point, there is always another better alternative. If you want to go for this particular portfolio, for example, let's say this particular portfolio, it will give you a return of 0.56 for about risk of 6.78. But if you just go to the portfolio right above that, it will give you around a return of 3.37 for just about the same risk, 6.17. See here 6.78, here 6.94. For just about same amount of risk, you get a massive increase in your return. So all the portfolios that are lying after this point, that means this part, is actually considered as not efficient, because each and every portfolio that is lying on this particular part of the frontier has a better alternative here, has a better alternative here. So investors will not select any of the portfolios that are lying in this portion of the curve because there is always a better portfolio here. Any investor wants to go for this portfolio, he can find a better one up here. If someone wants to go here, he can find a better one up here for about the same risk that he is facing. Therefore, this portion of the curve, we do not consider it as the efficient frontier, right? So efficient frontier is starting from the least standard deviation point. That means the point that you get the lowest amount of standard deviation and going up here. So let me, if you want to modify this particular thing, you can modify if you want. That means you will have to get rid of these values. That's all. So let me name this curve using these letters so that you can have a better understanding. I'm going to name the least risk point as L, the tip of the bullet, and highest risk point as G, and the lowest return point as K, lowest return point. Now you can clearly understand this. From L to G, it represents the efficient set of portfolios. This portion is considered as the efficient frontier. But from L to K, obviously, this is actually represented by the portfolios that are not efficient, because each and every single assets that are plotted in this particular graph are better than the whatever the portfolios available in this portion, right? So no investor will go and select portfolios from this part of the curve. So you can easily get rid of this part. You can identify the least risk point. Obviously, we have already identified that was 4.18 and corresponding return is 1.96. So all you have to do is remove that portion from the curve. So you get only the efficient frontier. So efficient frontier comes from point L and going up to point G. Now you can see here these individual securities cannot be considered better than the portfolios that are available within this line. So a rational investor, a logical investor would choose a portfolio that is lying on this efficient frontier. But in reality, there are millions of combination on this efficient frontier. So in other words, there are millions of combination of risk and returns and millions of combination of portfolios on this particular line. So the next question that pops into our mind should be, how come an investor go and select one of these investments? That is actually answered by the Marquis portfolio theory, where an investor would select a suitable portfolio based on his risk attitude or the attitudes towards the risk and return combination, right? In the upper portion of this curve, the efficient frontier close to G, you will get less risk averse investors, where there are investors who are really keen on bearing risk. They just do not bother about bearing high risk, and they are looking at high returns. So those type of investors will be investing the portfolios that are lying in this portion of the curve. And those investors who are more risk averse, that means people who really want to avoid risk, really do not want to bear high risk, will select this portion of the curve closer to point L, where they are expecting low returns as well as low risk, low return and low risk. In the middle part of the curve, we have moderate risk averse investors where they are happy to bear some amount of risk for a moderate amount of return. So based on the investor's risk attitude, each and every investor would select a portfolio on this line. More risk averse investors will select a portfolio here in the latter part of the curve closer to L. Moderately risk averse investors will select from the middle part of the curve, and less risk averse investors will select a portfolio from the higher part of the curve closer to G, closer to G. So that is how an investor select a portfolio on the efficient fund. So that is the decision then investor has to take based on his risk attitudes or the attitudes towards to the combination of the risk and return.